All right, welcome back, everyone. We are now episode 13 of the Avid Investor Podcast, and I'm excited here. I wanted to let you know that I'm excited to be here. I'm excited to share these messages with you guys. And if I wanted to ask you a favor, if you've been tuning along so far, if you found value, inspiration, guidance, anything in these messages, this information, this content that I'm sharing, do me a favor and please take the link, share it on your social media, send it to a friend, send it to a relative, business associate, whoever. If you know somebody that could benefit from the messages that I'm putting out there and the content that I'm putting out there, share the link with them. And if you are following along, make sure you subscribe. Go on YouTube, Spotify. We're now on Apple Podcasts, Amazon. It's all over the place. So if you can, hit the subscribe button, share it with somebody that can benefit from this message, and help me spread the word here. So I thank you for that. If you can do me that favor, I would greatly appreciate it. And the more we can grow this, the more of a following we can get, the more content I'm going to continue to put out there. So please, if you can, if you find value, help me grow this. That's all I'm asking. So for today's message, what I wanted to talk about today is the difference of rich versus wealthy. In my opinion, there's some common misconceptions or some misunderstandings, but there is a huge difference between the two. A lot of people, growing up, younger folks, whatever age you are, a lot of people say, I want to be rich. I want to be rich. Well, what does it mean to be rich? What does it mean to be wealthy? And, what I wanted to do today is dive into again, this is all my opinions, but my opinions on the difference between the two. So, if we go back, I think I really feel that Robert Kiyosaki said it best or defined it best. And for those of you that don't know, Robert Kiyosaki is the author of a book that was written many years ago, Rich Dad Poor Dad, and then there was multiple books that were spin-offs of that message. But if you haven't read that book, Rich Dad Poor Dad, it's great. I mean, it's great for young folks, whatever age you are. It's a good read. It's an easy read. It's something that you can share with your kids. The difference, Robert Kiyosaki's take on, being rich, or, he had two father figures in his life. And one he called his rich dad, one he called his poor dad. So, and it wasn't, because of the amount of money they had. It was just, more so their outlooks on things. So, if you want to take a look, dive into that book. It's a quick, easy read. But again, it's highly recommended. But if we back up on what I was getting to, the difference, Robert Kiyosaki's take on, the difference of being rich versus being wealthy is, rich is measured in dollars and wealth is measured in time. So what that means is, if you have $1 million, a lot of people think that's rich. I'm rich. I got $1 million or whatever that dollar amount is. I got, $100,000. I got 10,000. I'm rich. Whatever that means to you, whatever that dollar amount is to you. But we use $1 million, for example. So, if you have $1 million, I'm rich. A lot of people think you're rich if you have $1 million, but by Robert Kiyosaki's explanation, rich is measured in dollars, wealth is measured in time. So, for example, if you have $1 million, that may be a lot of money. You may think you're rich, but if your expenses are $100,000 a month, your runway is 10 months. So wealth, rich is measured in dollars, wealth is measured in time. Regardless of the amount of money you have, if you compare it to the amount of time that money will last, that's how you measure wealth. So, many folks, there's a lot of folks out there that, that $1 million, that would last, far longer than 10 months. But believe it or not, there are a lot of people out there that have, super high monthly expenses and commitments. And, what I call the burn rate. The burn rate is high. And when I say burn rate, I mean, just the money burns. You got those expenses, you got those commitments, you got to feed the machine, you got to keep that fire going. So I've talked about in previous episodes, assets down, liabilities down, assets up. Keep that margin wide, and then that'll create a longer runway, and you'll need less fuel for the fire to keep that burn rate down. So rich is measured in time, or rich is measured in dollars, wealth is measured in time. So how do you buy yourself more time? How do you create wealth? How do you create a longer runway? How do you make your money last longer? How do you create more wealth? And then, it goes back to what I've said in previous episodes, previous messages, is taking that money that you have and creating, buying assets. Don't forget about the liabilities. Of course, I like some nice things. A lot of people like nice things, but when you're early on in your business, when you're getting started, in a business as an entrepreneur, you might have some success really early on, especially, when we have a market like we do today. If you've started your business in the last couple of years, you're a house flipper, builder, whatever. I mean, the market is going up, so you've likely done really well. Now, in my opinion, what you need to do is have a long-term plan. Create that wealth. You may have went from, making X amount of dollars per year. You started your business. You've done really well. You've done a lot of really cool projects. You've made some big paychecks. Now, what are you doing with those? You're now rich. You have a lot more money than you used to. What are you doing with those paychecks? What are you doing with that surplus of cash right now? Are you focusing on liabilities? Are you out, buying new cars, buying new houses, boats, vacation homes, going on vacations, going out to nice dinners? Or are you reinvesting in yourself? Are you reinvesting in your business? Or do you have a long-term plan? So, that's been a focus of mine for many, many years, is the long-term play. As I said, we operate under the private equity model. We focus on safety and security, and I'm not going to harp on that too much, but, the bulk of our portfolio, the bulk of what we do is long-term plays. And that's because, we use that as a tool to create the cash flow for both our management company and, our equity partners. So what we're doing is, we're creating the wealth, we're creating the time. We've, when I started in this business very, very early on, almost 20 years ago, I didn't get caught up in the shiny object syndrome. When I went from making X to, making X, whatever those numbers were, I was constantly, reinvesting in my business, going into bigger projects, larger projects, more projects, and then a little bit later on in my career, I really started focusing on the long-term plays, the wealth building, the cash flow, the passive income. And basically what we've done is we've taken those dollars that we've earned, and we've created more time with those monies. So, rich versus wealthy. Rich is dollars. Wealth is measured in time. So by investing in the long term, by investing in long-term plays, by creating those cash flows, creating that passive income, as well as keeping those liabilities down. And when I say liabilities, if you missed a previous episode, a liability is anything that costs you money. An asset is anything that makes you money. So I'm not going to dive into that too much. We already covered it. If you want to know more, just go back to the previous episode. It was like, episode 2, 3, 4, something like that. Difference of assets versus liabilities. But again, to create that wealth, you want to get those assets up and get those liabilities down. And those assets, those things that make you money, that create that passive income, that create that, some call it residual income, that buys you the time, that creates the wealth. That's the long-term plays. And again, real estate was was not designed to be and many people will argue me on this point, but real estate was not designed to be a quick transactional thing. It's long-term plays. That's where the focus should be. And why do I say that? Because there's transactional costs involved in real estate. When you purchase a property, there's closing costs, there's transfer tax. At least in PA, we have, and in Pittsburgh, we have super high transfer tax. So if you're gonna pay your transactional costs on the front end, then you're going to immediately sell a property. You're going to pay your transactional costs. That cuts your margin down. So, again, one of the reasons why we focus on long-term plays, it eliminates some of those transactional costs. And, of course, there's tax ramifications on short-term plays. There's greater tax benefits when you invest over the long term. But again, to go into, rich versus wealthy, the goal should be, regardless of what business you're in, regardless of what profession you're in, is not you shouldn't be constantly chasing, in my opinion, you shouldn't constantly be chasing that next deal, to make another big paycheck or to make more money. Is it okay to do it? Yes, absolutely. But when you're doing those short flips, or whatever they are, those builds, and you're starting your business, you're starting to make some more money, you're starting to make some more income, just make sure you look at the long-term play. What are you doing with that? Are you going for that instant gratification where I did this flip, I made, $30, $40, $50,000 or more or less, or whatever that number is. What are you doing with that money? What are you doing with that big paycheck? Are you going out and buying something that, yeah, you like it, it's cool, you got this new car or whatever, but did you need it? Was that a wise business decision? Look at every decision you make. In my opinion, you should look at every decision you make as a business transaction, every financial decision. If I buy this product, if I buy this item, is it going to benefit me in the long term? Is it going to benefit my family in the long term? Or is it just something that I'm going to be happy with, for a couple of weeks or a couple of months or a year, and then it's going to be, a pain in the butt to deal with, or, I'm going to sell it down the line and lose money. So again, is it okay to buy those things? Is it okay to, buy nice things and have nice things? Absolutely. But there's got to be a balance between the two. If you're getting into the business, if you're starting a business, if you're in real estate or whatever the business is, and you go from making X, whatever that dollar amount is, you start your business, you start doing well, and you start making a lot more money, you become rich. Are you hemorrhaging that money on, payments and things that you don't really need? Or are you taking a portion of that and reinvesting for the long term and creating the wealth? So again, that's my opinion. That's my take. And from this message, I think you can gain a little bit more insight on, my personal strategies. But, from the get-go, you should have a plan, and you should review that plan and those goals, regularly, whether that's annually, semi-annually, monthly, weekly, whatever you feel the need to do. You should have those goals. And, we've talked a little bit before about AIPs, automatic investment plans. Those are good for creating some long-term wealth. And basically what an AIP is automatic investment plan. You have your income, you take a portion of your income and designate it to this, you take a portion of this income and designate it to that. If you have children, maybe you're doing the college savings funds. If you're an individual, maybe you have, depending on your income levels, you might have Roth IRAs, you might have solo 401ks, or you may have other investment vehicles available to you. It's important to designate a certain amount of money to those investment vehicles for long-term plays. We personally, we're in a business of real estate. We buy a lot of real estate. So, I'll look at again, long-term plays, both with our private equity model, with our investment partners, and, also for me as an individual, I look at acquiring acquiring, more properties. I look at, buying down debt. We've talked about that in previous episodes. If you have a chunk of money, a chunk of excess income, you can take that money and you can invest in a new property. You can invest in something different that's a different investment vehicle that's a long-term play. Or, if the ROI is there, you can buy down some existing debt. If you have a mortgage against an existing property, I look at it, can I get if I pay down or pay off an existing property, can I create 10% or more ROI on that pay down? If I can, then I will do that. But again, those are wealth building. Those are the wealth building investments. Those are long-term plays. Those are creating more passive income, more residual income, creating more equity, creating more capital growth, for the long term. And that all goes back to building wealth. And on the flip side, if I were to take that money, that excess income, and just buy something that I didn't really need, buy a boat or buy a car, buy another car, or, go on some fancy elaborate vacation. Again, we all like to do that stuff, but there's got to be a balance between the two. But when you buy those items or buy those liabilities, invest in those liabilities. I wouldn't say invest. When you spend money on those liabilities, that takes away from your wealth building, your cash flow, your passive income, your residual income. And it's amazing if you look at a financial calculator, and you look at the different investment vehicles, the long-term plays that you have your money invested in. It's amazing, how you can invest in certain things, and let time build that investment up in multiples over a longer period of time. So it's definitely a balance between the two, between buying assets and buying liabilities. But again, you should have a plan in place. You should have a focus or a plan that covers today's wants and needs, but then also have a separate plan or part of your plan that focuses on the long term, on the wealth. To me, we don't look at I don't look at just creating wealth for myself, but I look at creating generational wealth. What can I create? What can I spend my time and my money on to create something, create this generational wealth that can be passed down to, my kids and, maybe my kids' kids someday. So, what it comes down to, it boils down to, when you're gone, nobody's going to give a shit what kind of car you drove, or what kind of house you lived in, or what kind of vacations you went on. But people are going to remember the impact that you made, what you created, what you've built, the things that you've amassed, the things that you've created, the lives that you've changed, the benefits that you've created and that you've made for other people. So, and those are all things that you can do, when you focus on building that wealth, and not just, making that money and getting rich. So, that's it. That's my message for today. The difference on rich versus being wealthy. And again, if you had a chance, if you have an opportunity, check out that book, Robert Kiyosaki, Rich Dad, Poor Dad. It's a great read. It's an easy read. And just as a side note, if you decide to get into that book, if you've already read that book, Robert Kiyosaki, he talks about real estate, investing in real estate and owning real estate. Well, it's interesting to know, or to me, it was interesting to know that, Robert Kiyosaki, I found this out many, many years later after I read the book. Robert Kiyosaki does own a fair amount of real estate, and he does invest in real estate. But Robert Kiyosaki doesn't actually go out and find his own houses. Robert Kiyosaki doesn't manage his own investments. Robert Kiyosaki invests in, believe it or not, a private equity model. he invests with a private equity company, and the owner and founder of that private equity company that he invests with is a good friend and mentor of mine, John Burley. So, when you see Robert Kiyosaki talking about real estate and real estate investing, he's investing in the private equity model, the same private equity model that we do here at AVID Management Group. I mean, as you guys know, John Burley is a good friend and mentor of mine. We just had him on a previous episode, or we have him on an episode here, an interview. If you didn't have a chance to listen to that, go back and tune in, check it out, learn about the private equity model, learn about what they do. It's to the T verbatim what we do at AVID Management Group. And why is that? Because we learned the model from John Burley. So again, if you get a chance, take a look at that book, Money Secrets of the Rich. Yes, I recommend a lot of books, and I talk about a lot of different books because, I get people asking me when they get into the business, hey, what book should I read? So why not talk about the books on the podcast? Why not give a recommendation? If I feel strongly, if I took the time, I'm not much of a reader, but if I took the time to read the book, chances are pretty good if I'm recommending this book, I've read it more than once, and I've gained something. I've got some knowledge, some inspiration from the book that was able to change my life or help me or guide me in my business in one way or another. So again, that's the reason for the book recommendations. If you get a chance, check that out. And again, if you find value in this message, in these podcasts, please, take the link, share it on your social media, go to the different sites, YouTube, Spotify, Apple Podcasts. It's on Amazon Music now. Go to those different links and then, hit the subscribe button, and you'll get notifications of when a new episode drops. And I thank you. I thank you for following. I thank you for listening. And feel free to reach out to me if there's a certain topic that you want me to touch on, that you want me to talk about. Let me know. I'm happy to dive into it. So that's it. That's the message for today. Thank you for listening, and I hope you found value in this. Have a great day.